You know, US stock indexes seem to be even more resilient than a serial killer in a horror movie right now. No matter how many times we see them knocked down, they just seem to bounce back with even more conviction than before. And there were a mix of concerns that were quite justifiable in the impact they had on the markets recently. We had the uncertainty over Omicron even before we knew it as Omicron. We had our buddy at the Federal Reserve, Jerome Powell, seeming to become a bit more hawkish. And so, understandably, people rushed for the exits. Then details about Omicron started coming out, suggesting that, yeah, it's very transmissible, but maybe not so damaging, maybe not going to lead to more hospitalizations. And the market just seemed to shrug off the Federal Reserve uncertainty. And so, as we've seen time and time again, stocks bounced back. But if these markets are going to push all the way back up to all-time highs once again, there are some obstacles that need to be overcome. And the first one may be on Friday this week when we have the release of US CPI data, that's inflation data. And if you're not sure what CPI actually is, other than just knowing it's a measure of inflation, click up here to check out our video we released just last week that explains everything. So the median expectation for that release is that the year-on-year rise for November will show 6.7%, and the monthly rise will be 0.7%. So that annual rate, the year-on-year number, that would be the highest level since 1982. That's even way before I was born. And keep in mind, the Federal Reserve's target is average inflation of 2%, so that's way above that. So what does this actually mean? Well, firstly, according to the FT breakfast indicator, which might just be my favorite measure, where it's up there with the Big Mac index, it might be time to start doing intermittent fasting if you're an American, or bringing forward your New Year diet because breakfast costs, they're going up. But more importantly, it's pointing towards the expected action from the Fed at their next meeting to be that they're going to pick up the pace of their tapering so that they can raise rates sooner if needed. Of course, on Friday last week, the jobs numbers missed expectations quite significantly. They came in much lower. And I think that this was the encouragement that some people needed to think that the Federal Reserve will delay taking any further action. After all, the Fed are focused on their dual mandate of maximum employment and 2% average inflation. And it seems recently they've been prioritizing the labor market while thinking, at least up until last month, that inflation was transitory. But realistically, with all the comments we've seen coming out from Fed members and all the data we've seen, and if those inflation figures come out very high like we expect them to, it does seem very likely that they will accelerate their tapering. But whether that means that interest rate hikes will come sooner is another matter altogether. In fact, if we go back to that FT breakfast indicator again, and not just because I'm starving, that's on this useful page that the FT put together to give latest figures on inflation from a bunch of countries around the world. And an important point is this chart here that shows CPI by the main components. And we can see energy stands out way ahead of any other component. So if energy costs do drop at the start of next year, as the EIA have suggested, then maybe by the time the Fed are looking to raise rates or deciding whether they're going to, which would be likely in the middle of next year, they might not need to be as hasty. And so going back to the US stock indexes, looking to buy the dip at the previous higher low doesn't actually seem that irrational. In fact, just last Wednesday during my live stream trading session with our members, we were mapping out levels around that area to look for long opportunities. Because what's clear is that despite the sudden plunges in the price, the buy the dip mentality is still there in the market. And those severe drops in price can actually be partially explained away by liquidity conditions in the market. And that's something we'll discuss another time. But speaking of liquidity, there was a great article by Joseph Wang, the Fed guy, who explained how even after QE comes to an end, there's still another $1 trillion in Fed liquidity that will gradually flow into the private sector and boost financial assets. So we still have, as he calls it, the QE after party to come. But despite all of this, there are still huge risks, and those huge risks are made even worse when people get complacent by thinking they can always buy the dip and it's going to continue working. As Paul Singer, founder of Elliott Capital, said in a recent article, at present risks are at or close to the highest levels in market history. For instance, the market capitalization of all domestic US public and private equities is now at 280% of gross domestic product, much higher than the previous peak of 190% just before the collapse of the dot-com bubble. And household equity allocations are at an all-time high of 50%. Currently, policies across the developed world are designed to encourage people to believe that risks are limited and that asset prices, not just overall functioning of the economy, will always and forever be protected by the government. Due to this extraordinary support for asset prices, almost all investment strategies of recent years have made money, are making money, and are expected to keep making money. The most successful strategy, of course, has been to buy almost any risk asset, leaning hard on the latest fads, using maximum leverage to enhance buying power, and buying more on the dips. So it's no wonder that under these manufactured conditions, investors would move out on the risk curve, investor speak for taking on more risk unconnected to expected returns. Most investors who say that they are willing to bear more risk do not actually mean that. What they really mean is that they fear missing out on the higher returns experienced by other investors. In other words, missing their benchmarks. Now, he mentioned something that I think is in the back of most people's minds, whether they'd like to admit it or not, which is that fiscal and monetary policy has made people believe that any sustained downturn wouldn't be allowed to happen. However, the ability for policymakers to actually protect against any future downturns may be reaching its limit. This means more than ever, we need to stay cautious about possible systemic risks. So you shouldn't leave yourself completely exposed by blindly buying every dip. Make sure that you're looking at what could happen on the downside. No matter how good things seem to be, there's always a risk that the punch bowl could be removed. And on that note, help to stop our market movers punch bowl from being removed by hitting the like button and subscribing to the channel. And that might be one of the weirdest segues I've ever done. Now, in terms of systemic risks, there was a great piece from Verdad Advisors explaining that some of the biggest risks right now are as a result of cheap credit. In particular, they're looking at three key markets, or overall markets, I guess: public equity, private equity, and housing. Now, in particular, a concern is private equity, because those are much more illiquid and investors might not be able to get out as easily, and conditions are not looking great at the moment. But even public equity, which is more liquid, really doesn't look that promising either based on what research they've done. The required growth rate of companies that have already seen incredible performance needs to be even higher to justify their current valuations. And as we know, typically companies that outperform will revert to the mean rather than continuing their outperformance. As for housing, it really depends on the state that you look at, but at the moment the US as a whole, although overvalued, is not in the disaster zone, but it could be a knock-on effect from some of those other states. And so with all of this in mind, on the topic of inflation, interest rates, rising markets, concerning credit conditions, I want to leave you with a quote from Morgan Stanley's chief global strategist from a couple of weeks ago. He said, "One of the big mysteries in the global economy is why, though inflation is making a strong comeback, long-term interest rates have barely budged in recent months. So far, analysts have explained this odd market behavior as a symptom of the pandemic, driven by fear of another surge in cases, or massive central bank asset purchases, or, above all, a belief that the current inflation spike is temporary. None of these explanations hold up well in the light of recent data, but there is an explanation that does. The world is in a debt trap." If you want to learn more about economic data, click this playlist to watch our series where we're covering all the economic data releases, or click this video if you want to see why Bridgewater think the current inflation problem is only going to get worse. I'm Nicholas, this is Market Movers. Thanks for watching.